Hello, my fellow Ripplers. This is Chris Miles, your cash flow expert and anti-financial advisor. Welcome to our show that's for you, those that work so hard for your money, and now you're ready for your money. Start working harder for you today. You want that freedom and cash flow now, not just 30 or 40 years from now, but you want it today so you can live that life that you love with those that you love. But it's not just about getting rich. It's about living a rich life because as you are blessed so much financially, you have a greater capacity to bless the lives of those around you. Guys, I appreciate you letting me tune in and binging and even sharing. And a special shout out to our clients that have been working with us, those VIP clients. Special shout out to you guys. I know many of you are listening. You've been trying to tune in, try to figure out what's next for you. And although we keep talking, I appreciate you guys always tuning in, even though you hear my voice way too much. So again, appreciate you guys tuning in. It means a lot to me that you guys actually show up here and you really want to have your life change. And so it's an honor for me to be able to deliver that value to you and create a ripple effect through your lives. As a reminder, if you have not done so already, go to our website, moneyripples.com. Go ahead, take that passive income calculator, find out how much you can create in passive income in the next 12 months. I have worked hard on that calculator to make sure that it's as accurate as possible, as if I'm running the numbers for you. Now, it's not 100% if you're not filling it out right, but again, that's why we have somebody that can also speak with you as well, a cash flow consultant, to see if maybe that's true, if it's accurate. If so, how do you achieve it? So definitely check that out today.
Chris Miles was able to retire twice by the time he was 39 years old, but he's not content to just enjoy his own financial freedom and peace of mind. Chris wants you to have your own ripple effect so you can live free today. He's not the financial advisor you expected. He's the anti-financial advisor you deserve. He's jumping behind the mic right now, ready to make waves. Here's Chris Miles.
All right. Speaking of which, I want to talk about real financial results and specifically around financial advising. I mentioned recently where I did a podcast about, that using that example of the attorney. And if you haven't gone back, I definitely challenge you to go back, about 4, 5, 6 episodes, whenever it was, where I was talking about that attorney and looking at apples to apples, how we match up compared to traditional financial advising and the way that they do it. And it's a very different philosophy. Now, one thing I want to say too, and I think I said in the episode, but as I went through it again, I couldn't, I don't remember hearing it, but I want to just say this, is that first and foremost, I don't believe financial advisors are lying to you, at least not intentionally. There might be some that could be, but I think the vast majority of financial advisors are good-hearted people. Some of them are friends of mine in the industry, really trying to help your life too. The problem is that the information they're given that they then pass on to you may not be exact. It may be faulty. And that's what happened with me as a financial advisor when I was doing that 20 plus years ago. And I want to kind of take you through that journey a little bit just to kind of get you in that mindset. I teased it a little bit in that episode a few episodes ago, but I really want to take you into that mindset of what we were teaching versus what the reality is. Okay, so I just want to go first and foremost, talk about the stock market. There's really a few assumptions that as financial advisors we were given that were incorrect. Number one is the rate of return in the stock market. Number two is the inflation rate. And then number three is really just, how much you can pull off of, how much can you actually live on in retirement. That was really our biggest struggle. Once I started to become more of that planner and I started to see more of the reality of people's situations, the thing is your life doesn't actually fit into a calculator very easily. It's really hard to estimate the future, especially because we don't even know if you'll be alive in the future when they talk about this someday. It's kind of like how I joke about people that are Dave Ramsey fans. They get so psyched up that they're going to be debt-free in 13 years. They're like, yes, it's awesome. Really, how much debt you paid? No more than yesterday or just a little bit more than last month. Okay, cool. You're on your way. They get excited. I always remind some of my clients that too, because sometimes they're like, oh man, that 5 years of financial freedom, it might be 6 or 7. And some people wait 13 years just to become debt-free. And even then, they're not even close to being financially free, right? So that's the thing is that, it's always perspective, it's expectations. And so many people even get excited when they meet with a financial advisor saying, oh my goodness, man, in 30, 40 years, I'm going to be a multi-millionaire. It's going to be awesome. Okay, maybe so. But let's just see what happens. This is where we have this reality, right? Because I mentioned before, Fidelity came out. They announced their average 401k balance, $103,900. That's not a lot, guys. That's very, very little. And they even said that the number of 401k millionaires have gone down. Now they're 299,000 after 2022's hit. right? The market went down about 19.5% in the S&P, but it was over 20% in Fidelity. So I'm actually going to use Fidelity's numbers because I want to use some of the reality here, as well as the stock market, and show the difference. So I've got the S&P 500 all the way back to about 19, I think it's 28, 29, what was it? 1928, okay? So we're going way back here. Now, I want you to see, because we're in a key period right now where the market is well above its typical average, right? It always bounces off what's called a trend line. You notice here over time from the Great Depression when it hit the bottom there, but then I even started the point around 1942, it bounced off that line, then bounced off it again in 1974, and kind of rode it up through the 70s into the 80s. And then it took off into the, Y2K, and then it started pulling back until eventually, bam, it hit that trend line again, 2009, March 2009. It's interesting. Sometimes we hit highs, sometimes we hit lows in Marches. It's not always a March, but it's kind of interesting lately. We've seen that pattern a little bit. I want to mention this because I want to talk about what people expect and what they see at the stock market versus the reality of how their funds perform. Now, I'm not completely 100% anti-stock market, but I am definitely anti-mutual fund in over-promising and under-delivering. And that's what mutual funds have done traditionally forever. I mean, even when I was a financial advisor, we were even talking about the stats that 90% of funds actually underperform the stock market. That's still true today. Most funds never even hit the average from the stock market. I'm going to show you that here when we start looking at some Fidelity funds. But look, here we are. This is as of mid-April. We got the market all the way up to 41.54. I actually predict that as we go into May and beyond, we're going to start seeing it pull back. There is plenty of room for this to pull back. So this trend line currently is about, as we see here, it's about 1,700 or so. We'll even say 1,800-ish, right? I tell people that if we see the market go down, the S&P could easily go down to about 2,000. That would not be far-fetched. That would be over a 50% loss from where it is today this spring. That would be drastic for people, especially because the last year we already lost about 7% in the stock market, going from 1 year back to April of 2022. So this is a big deal. Now, of course, over time, I look at the average. Now, I've gone over the real averages of the S&P for the last 30 years. It's been about 7.6%. 7.6 is not 12. So we taught 12% was what it was, right? So if I were to run the numbers with you to show you these numbers, say that you're putting $20,000 a year away into your mutual fund. This could be your 401k. This could be whatever. $20,000 a year you're contributing. You're starting from zero. You do it at 12% interest that you're earning because, hey, it's the miracle of compound interest. It's the eighth wonder of the world, right? You're going to do that for 30 years. And then we calculate. And what do you get? You get $5.4 million. And you think that's fantastic. And you know what? That is fantastic. At least we think. Now we got to ask ourselves in 30 years, what is that in real money, right? What is that with inflation? Well, I put this at 3% inflation. So if you look at after inflation adjustment, that's 2.2 million, about just under 2.25 million. Now, I knew at that time, we were saying 4%. I wanted people to figure out how to live on that. So here's the thing. Figures don't lie, but liars figure, right? And again, I'm not saying financial advisors are all liars. I'm not saying that, but I do know that as a planner, it was really hard to want to be conservative on these numbers because it got depressing. For example, if instead of 3% inflation, I look at that and I say, let's say you live on 3%. I used to say the 4% rule as well, right? Well, 4% of that would bring it pretty close to about $90,000 a year. But if it's 3%, now we're looking only about $66,000 a year. Doesn't sound as good with after inflation, right? You're putting in $20,000 to live on $60,000. So I would do things like, oh, well, let's do it at 2%. And then I was like, ooh, look at that. Now, after inflation, that's better. That's almost $3 million. Well, $3 million at 3% is $90,000 a year, or at 4%, $120,000 a year. Yay, this is great. You make $10,000 a month. You did it. $20,000 make $10,000 a month. But I'll tell you, as a financial advisor, I started getting more conservative because I realized the returns weren't what they claimed. These are just averages based on small cap stocks, not large cap. Like everybody else talks about, the S&P 500 is large cap. That's 10%. What if I only drop it 2 more percent? Now we're down to 3.6 million. Well, what if I did 3.6 million? And of course, you have 3%. Now you're at 1.49, about 1.5 million. At 3%, that's 45,000 a year. Doesn't sound great, does it? So again, if I want to make it look better, I put it down to 2% inflation. I was actually showing 2% inflation before the feds were even talking about 2% inflation. Why? Because I wanted to be a good planner where I wasn't showing 0%, because legally They could show you 0% inflation. They could say, look, 3.6 million. Aren't you happy? 3% of that, you're living on over 100 grand a year after you pay taxes. But that's another story, right? So all these things would come up, and I would just tell people, look, this is good. Well, what if the average is actually more conservative? What if it's only 8%? Watch, boom, it drops down to 2.4 million. Now you're living on 3% of that. You're living on 74,000 a year, right? But if I put inflation back in 3%, oh my goodness, now we're at about $1 million. 3% of that's 30,000 a year. How many of you get really hot and bothered saving 20,000 a year to only live on $30,000 a year in retirement? You do this for 30 years, only realize that, oh, I hope I can live on 30,000 a year and not run out of money. That doesn't get so exciting now, does it? And now I might focus again on the 2.4 million, almost 2.5 million, saying you have almost $2.5 million, multi-millionaire. Congratulations, this is great. But it's not good at all. Now, here's the problem. If you look at what these funds are really doing, you'd probably be likely to make 7%. I would say 7% is still a kind of a liberal return, a reasonable return for that. But I wouldn't put inflation to 3%. The truth is, if you go to places like, Shadow Stats, we have, places like that where if you go to shadowstats.com, you look at their inflation rate, it's actually been about 7% higher than what the feds claim. So if the feds say 2%, it's really been closer to about at least 8 or 9%. If they've been saying it's 10%, you're probably looking more like 17%. And you guys, you kind of know it's true when you look at real life. Again, I want you to come back to real life numbers here. Is it really that good? Well, that's the problem we're running into. So when I'm looking at this, I say, well, what if I want to use these numbers instead? So here's the numbers right here we've been showing you, or I've been showing myself. Now you get to see it too. So we have the 7% inflation or 7% interest rate with 20,000 a year going in for 30 years. But what if we made this just 5%? I think, like I've said before, 5% is a conservative inflation number. That's more realistic. Look, guys, $467,000 is what you have. What's 3% of $467,000? 3% of that, guys, is just under $14,000 a year. $14,000 a year. Then you got to pay taxes on it. So you saved up $20,000 to live on less than $14,000. Do you get excited now? Can you also see why I started having a dilemma as a financial advisor when I said, ooh, let's put that back to 8. Okay, I'll put it back to 8 after inflation adjustment. Oh, it's still $500,000. It's not enough. Let's go down to 2%. Oh, okay, 1.35 million. I can work with that. That's 40,000 a year. At least they're making double what they put in. Whew, I'm good. See how easily I was just able to manipulate those numbers, right? Now, I'm not lying necessarily because, again, Fed's targets inflation is 2%, right? And we're just factoring 2%. The truth is, past performance is not indicative of future results. That plastered everywhere. That disclaimer is plastered everywhere. Even the 8% doesn't mean you're going to get 8%. Nothing is guaranteed in the stock market. No promises are ever made. In fact, if you ever to say, hey, can you guarantee me this? The financial advisors say, I can't do that. I can't even use the word guarantee if I sell mutual funds, right? The only time you can use the word guarantee is if you have like an annuity with a guarantee on it, some kind of guaranteed feature. But other than that, you're pretty much, that's erased from your language. There is no such thing as guarantee. So look, again, I go to 5%, which I think is, again, conservative inflation. I'm being devil's advocate against my own point here in favor of the mutual fund. 7% return, boom, right there, 14,000 a year if you pull off just 3% and you don't want to run out of money. Is it no wonder people need Social Security to keep living? Now you might say, yeah, but Chris, are they really only getting 7% a year? I'm so glad you asked. Let me show you. All right, we've got Fidelity's investments. There's a whole slew of them, right? What I love, it even shows you the expense ratio, right? It shows you that as well. It shows you gross and net, which are pretty much the same in all of these funds. Now, one stat that they came out with in another article, I'm not going to keep flipping between screens to show you here, but they said that of Generation Z and of the millennials, right, Generation Z, they are showing that 84% of them picked target date as the fund of their choice. Because, hey, if I want to retire in 2050, boom, put it there. 2060, I put it there. Well, how's that really done, especially the last 10 years? Now, as we go down this list, now, if you look at 2010, 2015, 2025-ish percent, 6%, 2025, I would start this at 2025 because obviously they're trying to keep your money if you're already past 2020. 2025, they're trying to get more conservative, but they're still trying to grow your money. Look, 10-year average, 6%. 6%. Now, even 2030, 6.82, eventually if you get to like 2040 and beyond, it's roughly about 8%. You might say, this is great, 8%. Now, the 2060 fund was only 7.34, worse for the 2065 because they just haven't been around that long, right? But 2060 has been around for a little while. And that's so roughly about 7-8% is what you're seeing here. That does not include the expense ratio. So if you have 8%, and these are all but roughly about 0.75, you see that pretty consistently down here in the later ones, not the ones that retire earlier, but the later ones, 0.75%. That means if it's 8%, you really only make 7.25%. This is for the last 10 years. That's the average. Now, think about this. What was the actual average of the S&P 500? Well, I'll tell you, 10 years ago, the S&P was at 1569. Currently, as I'm talking about right now, it's roughly about 4150. And even if I talk about the end of March 2023, just to make it even, end of March of 2013 to end of March 2023, went from 1569 to about 4017 or 4019. Okay, well, guess what? That's a 10.1% average return. This is, of course, with the booming 2010s. The 2010s were straight up. It was awesome. I mean, until we had 2022, we actually had roughly about a 14% real rate of return from 2010 or 2009 or 2010 to about 2022, to the beginning of 2022, before the market started going down. A 14% average. Now it's pulled back a bit because we lost 20% last year, gained some of it back early this year. So roughly we're looking about a 10% over the 10 years since 2013, 10% return, guys, 10%. Yet the target funds did, after expenses, 7.25. I want you to think about that. It's underperformed drastically. Now, it's no secret to any person that's a financial advisor. They know that the Fidelity target date funds, and even Fidelity knows, they don't even hit target. They don't even hit what the S&P 500 does. But if you're doing a 401k right now, you're trying to hit that, guess what? You're in trouble. Because what are we seeing? We're seeing the fact that you're not getting these rate of returns. So think about it. If you're 2% less, this number is 2% less, right? And that doesn't include the 0.75% in fees. And there could be more fees than this, but that's just what Fidelity is saying they charge. Look, 7.25 versus 10.1, that is almost a 3% difference. What if, of course, when we already know about 7.6 has been the average. And let's just say that the average S&P 500 is not 7.6, even though it is for the last 30 years, that the actual average yield. What if I bumped it up to, say, 7.75? I just bumped it up a little bit higher than that. But we still got to take away 2.75%. That puts you at 5%. So let's look at it. All right, so going back to our 20,000 a year, going to your 401k, but instead of making 7%, we make 5% after fees and everything else. What happens? Well, really, we're down just matching inflation, aren't we? So yes, now you have about 1.4 million, but you're after inflation adjustment, 322,000. What is 3% of that? Just under $10,000 a year. You went and saved 20,000 a year to now live on 10,000 a year. Now you might think this sounds a little bit too harsh, right? And you know what? Depending on what happens in the market, it could be. But don't tell that to anybody like my dad. Don't tell that to anybody who's pretty much a baby boomer right now, who has been drastically disappointed by the returns of their mutual funds, of their 401ks and IRAs. This is exactly why people are retiring. This is why there's only 299,000 401k millionaires out of 30 million people, right? Adults that can actually save in a 401k, that's all they see, right? And again, remember, of those that are eligible for 401ks, more than 50% actually contribute. So even if you say out of the, we'll even say 250 million adults, say half of them save in 401k, that's 125 million. Are you telling me that only 299,000 of them are able to do that? Does that mean like really only at one, maybe two out of every 1,000 people could actually have $1 million in their 401k? Does that seem right to you? No, of course not. It's BS. And that's because these are BS, right? Again, financial advisors, are they lying to you? I don't think so. But when I, as a financial advisor, when I started to see this, I had to really do, it was not an existential crisis as much as it was an integrity crisis. I had an integrity crisis. Do I keep teaching this stuff and just ignore these numbers? and just teach what everybody else has been teaching, saying, oh, conservative 8% a year, but really it's 10%, right? Do I keep doing that? Inflation's only 2, maybe 3%. Do I keep doing that? Do I keep ignoring even the fact that there's still taxes to be paid on that $10,000 a year, right? So then you're only netting like maybe $7,000 or $8,000 a year. And you're thinking, well, geez, I might as well be broke because I'm living on a fixed income in my retirement because I've been given these numbers to share with people, and it's been a big fat lie. And why is it a lie? Because that's what the Fidelities of the world want you to believe. Sorry, Fidelity, I love you. At the same time, I'm glad you have a service out there. I'm glad you're offering something for people that's of value. Yet, still, we look at these numbers and we say, ugh, that's not good enough, right? Especially when we pay fees that come out of it, which you don't talk about. When you're talking about investing in mutual funds, we just look at the total return. What's the market returning? Don't even worry about fees. Don't even worry about inflation. Don't even worry about that stuff. Turn a blind eye to it. It doesn't work, guys. It has not worked. I mean, it's just ridiculous. But at the same time, with our people, say they get, when they're getting 10% a year, even on that kind of money, yeah, they can save more. But here's the difference. If you earn 10% a year, and that's actual income, right? And say that's for 30 years. Our clients definitely don't have to keep working for 30 years. That's for certain. But even if they did, say they're only putting away 20,000 a year and they're just starting from scratch, making 10%, that's 3.6 million, but that's 3.6 million that they're able to live on 10% because they don't touch their principal, because that 10% is just paying them that income. Well, guess what? 83,000 a year after inflation. So it's still 20,000 a year to live on at least 83,000 a year, assuming 5% inflation. And that's if you only earn 10%. There are ways to do real estate investing to earn more than that. Not that there's any promises, not that there's any guarantees. And I'll be honest, it's possible you could lose your money in deals. At some point in 30 years, you're probably going to have a bad deal at some point. Here's the thing. Do I want to have a bad deal every once in a while where I could lose some money, but still overall my money's making money? Or do I want to be in a mutual fund where, yes, I'm going to have bad years where the market goes down. I'm going to have some good years, but overall it's just, It's like, it's just lukewarm, right? And it's not even lukewarm for that matter. It's like you have some hot years, you have some cold years. It's like weather, do you want scorching, blazing heat, or do you want frigid, cold temperatures? I would just like to have spring. I'd like to have nice, warm, steady, predictable temperatures, right? How can we have more like California? Well, not even California. Let's say it's like Florida, right? Hawaii, it's year round, kind of same thing. You might get bored of that. Maybe you like the excitement of losing money. Hey, who knows? Market might be good for you that way. But I'm not that person. I am much more conservative than that. I don't like to gamble my money. Stock markets, especially mutual funds, are a big gamble. And really, the one thing that's not gambling with the mutual funds is that you have a 100% chance of losing in the sense that you will not be financially free. It just doesn't happen. There's not the evidence in mutual funds where people say, yes, mutual funds, that's all I saved in. I put in that middle-class lifestyle of packing away in that mutual fund, didn't do anything with real estate, didn't do anything with any businesses or anything like that. I only saved in my mutual fund, and look at me, I'm free. That's long-term, that's not the case. Even those people, if they're retired, still, as you've heard me say last fall, when I had that case against mutual funds and we're putting them on trial and we brought out witnesses, right? And those witnesses, those people that had $1.5 million to $2 million that were beyond what most people had in their 401ks, they were still worried about running out of money. Still didn't feel like they had enough in those 401ks. And it's true. Let me show you one more thing, because here's where reality really sets in. All right, so let me go back to this chart, right? We already know mutual funds, they're not performing as well as stock market. That's a given. We know that inflation is not what the government tells us, because they're incentivized not to tell us. They don't want to have to raise Social Security so much that they go broke faster. We already have worries about a debt ceiling, not being reached. What are we going to do next, right? All these things. We all know that's happening. But when you start talking about real life situations, understand I've been in this game now for going on 21 now almost, guys. Yeah, 21, going on more than 21 years now. So, I mean, I got into the business as a financial advisor during Y2K, right? Right after 9/11 happened, I got in and I saw the worst down year, right? Now, understand, and I'm showing you right here, you'll see that Y2K, that little teeny blip right there, like it went down a little bit, August 1133, September, it was down to about 1040. So, I mean, and there was a big spike, but then it popped back up again pretty quickly thereafter. The fall, it actually started going back up again to where it was back up to where it was before, and even higher by the end of the year. But you know what happened? The worst, because the market was about 1,500 at its height. It was almost about 1,500 there, March 2000. You see 1,498 there. It hit about 1,500 as a high. That was the resistance it hit. It even hit it back again, August of 2000. So even August 2000, things were great. It did start coming down, leading into Y2K and into the 9/11, I should say. 9/11, and actually 9/11 was improving. And then it was 2002, worst year. We saw a 23% drop that year. Boom, it bottoms out in 2003, about March 2003 when it started to recover really. So it bottoms out. It ends up hitting about really almost 50% the way down from where it hit the high. Now it started coming back up again, and look, right at 2007, we get up here, and look, we're even to the fall of 2007. It's up around 1,500. Nothing's going wrong, even though I started seeing banking issues happening already, credit situations happening. I saw that especially by September 2007. Well, then all of a sudden, it gets up almost to 1,500. It actually breaks a little bit. So people are like, oh, I'm back up again to where we were in the market at least. And then bam, comes crashing back down. And that's what you see there, especially when you hit the low there, March 2009, it got down. And here it shows the end of February in this case, but still down around 825, almost a 50% loss once again. Then it bounces off that line and comes back up. Now, if you were to look at it, go to 2013, you'd finally say, okay, finally we get past 1,500 again, right? Good, and we broke it. Somebody might say in 2013, oh, good, it took 13 years to get back to where we were 13 years earlier. But in reality, that wasn't the case because of those fees and people not getting that same fund performance. And of course, if those fees are coming out while you're losing money, it takes a lot more returns to come back from that negative. Remember, if you lose 20%, you need a 25% return to get back to zero. You lose 33%, you need 50%. Heck, even Meta, Facebook stock, right? Meta dropped like 67%-ish last year in 2022. So now I'm hearing people say, whoa, but yeah, I made 80% year to date. Yeah, but understand what that really means. You lose 67%, you lose 2/3. That means you go down from, say, 10,000 down to 3,300. You need to make a 200% return to get back to where you were. So that 80% recovery is not that much recovery. Now, of course, Meta's laying people off again for the third time. If that's not an issue, talk about efficiency as they refer to it, that's an issue, right? So people, same thing. People just like my dad who are in retirement funds just like this. He was Y2K. He was thinking if things keep going up, right about 2000, he's like, if things keep going up, I can retire in my 60s. And again, he saved, he paid off all his debt. He did everything that Dave Ramsey would have taught him to do. Had my dad not been older than Dave Ramsey, probably taught him what to do. So he did everything right. But then, of course, Y2K was kicking his butt. So he had to wait longer. And then right when things started to come back, 2006, 2007, then bam, hits your retirement account again. Did you know, not just him, but clients that I met with, most of them didn't say that their money that they just left sitting there, most of them didn't see it get back. Not in 2013, it didn't hit break even. They were still losing. It was 2015 before they said, I'm finally now breaking even. Look, 2015, guys, by 2015, the market was over 2,000. Supposedly, that's a 33% better. But because of fees and everything else coming out over that 15-year period, they were really only looking at about in their actual returns, right? Because they don't get the market returns. It took them 15 years to get there. And guess what? Just because it took you to get to the 2,000 the S&P to finally feel like you're breaking, or finally get to the point where you're actually breaking even, you have as much money as what you had in before in 2000. Problem is you just lost to inflation. By that point, it's more than doubled. So guess what? It's like you lost 50% by 2015. You know what double that is? Right where the stock market is now, around 4,000. So that means if you were invested in 2000, you had your money in there thinking, I'm doing great. Now, after inflation, you're finally feeling like you got your money back 23 years later. It took you 22 years if you count, the nice big high that we had in 2021, really, right? 21 years, it looked better. But it took you over 20 years to get back to, with inflation, feeling like, okay, now I think I'm about breaking even. Guess what? Now it's going back down again. What does that do to you? You don't want to be in a place where you just break even. That's not cool. That's not what we want. That's not what I want for you. This is why I get so angry at this. This is why I keep banging this into your head that mutual funds and the traditional retirement plans are broken. They don't work. And there's no accountability because of the fact that you can state these numbers, because all you have to do is find them on a chart. You can state 10% or 12%, as long as you can point to it on a chart and just say past performance is not indicative of future results. You can run those calculations, it doesn't matter. And by the way, this doesn't just happen with mutual funds. This also happens with life insurance. You have people with index universal life saying, oh, well, the market's done this and this is what it is. Understand that 20 years ago, I was selling those indexed universal life policies before they got popular. And you know what? We had caps where the top rate, top interest rate that they could hit was anywhere from 10, 12, or even 17% with the companies that we offered. You know where it is now? Maybe 8 or 10. So they lowered those. But hey, we did projections based on those 10, 12, 17% projections of what the market does. Like, hey, well, if we had this back in the market days, which we didn't, but if we did, going back, showing this, whole Monte Carlo simulation, right? Look, you would have had this much money. Well, not if they lower those caps and even lower some of the minimum guarantees too, because we had at least 1 or 2% as guarantees, not 0 or 1, maybe a rare case you might find 2, but usually they'll cut the cap way down and give you a 2% guarantee. It's not the same. And so when you have all these people telling you, here's what it could look like based on the market, type of returns, no, that's not good. That's not good enough. And the longer term you have to go out, the more uncertain it is. Just like anybody who's around Y2K thinking, I've got money, maybe in 10, 20 years, I can retire too. And now they're at the point saying, hopefully in 10, 20 years, I can still retire, even though it's already been 20 years. It keeps pushing out the timeline. The best thing you can do, the best way you can fight inflation, the best way you can fight all of this is, one, don't lose money. Don't gamble in cruddy little mutual funds that make less than the market returns. And when you lose bigger than when the stock market loses. And then 2, you actually get real fast cash flow now, passive income now that you can actually see as reality. It's not numbers on a piece of paper or on a computer screen. It's real, right? And again, I'm not saying that you're going to be financially independent tomorrow. This is not get rich quick. But there are many times we see people saying, look, you've got the money to do it. I just saw my Facebook memories 4 years ago, a woman I spoke with in Arizona. She was a single woman, health coach. She's saying, Chris, I want to retire. I'm not sure if I can. And I said, what's your retirement goal? How much do you need per month or per year? She says, if I get $2,000 a month, that's really all I need. I live pretty inexpensive. I basically have no house. I have no mortgage payment or anything. So $2,000 a month is all I need. And I said, well, what do you got to invest? She's like, I have $250,000. I said, guess what? If make a 10% rate of return on that, you'll actually have $25,000 a year or $2,000 a month. Her goal was to retire in 10 years. And she's hoping that maybe she might be able to do it with her mutual funds. $250,000 at 3% was only giving her $7,500 a year. She wanted $24,000 a year. She knew she's going to have to somehow triple it in the next 10 years. Well, I said, here's how you can do it in 1. You know what? That's the cool part of the story. The sad part of the story, she couldn't believe it. She didn't believe it was reality. The truth is that I was giving her conservative numbers, especially 4 years ago. 4 years ago was 2019. Guys, I had done investments in 2019, made way more than the 10% in all kinds of real estate, and they did well. Even today, I'm not saying that you always get 10%. There's certain deals you'll get less. Some of you make more, but it's not uncommon to see 10% in many cases. Well, for her, she could have easily exceeded that, had more than that. If she had kept doing her health coaching, which she only wanted to do that a couple hours a day anyways, so that would just be bonus money for her. She lived on that, had fun, had a lifestyle, took that, reinvested it, kept building her income. It's not, who's to say she wouldn't have had maybe another extra $500 to $1,000 a month by this point? And with inflation, that would have been very nice, wouldn't it? So my point is this, guys, is that the sad part of the story is that she didn't take action. The great part of the story is that many people have. Many of those people you've heard on my podcast, some of them came in 2019, were able to weather the storm in 2020, even if they got furloughed or laid off of their jobs, were able to make ends meet until they got jobs again. Some of them were already financially independent. Some of them are becoming financially independent. Some of them already are financially independent. And so I'm just here to tell you, this is why I left being a financial advisor. This is really how I can say I like what we do. Again, I never promise any guarantees because the truth is that anything can happen in the world. We don't know. There are no guarantees. We don't even know how long we'll be alive. But I can tell you this, is that there's a lot more evidence supporting what we're doing by leaps and bounds with real life people, just like the people we've had on this podcast, versus people with mutual funds, which you don't find on this podcast. And even we try to find them, it's dang hard to find them. So I'm not going to beat that dead horse anymore. I'm just here to tell you the proof's in the pudding. Their numbers are real. Stop going with the whole figures don't lie, but liars figure. And they're trying to project out for decades in the future that you really have no clue if that's going to come out to be reality. And the truth is, it's been overpromise and underdeliver. I'm sick and tired of it. I hope you are too. I hope you make a change. If you want to make a change, like I said, if it's your time, great. Feel free to reach out to us, but at least do something. Find a way to take control of your own finances and not leave it up to chance. Don't leave it up to what the financial advisor is not really doing for you. Don't leave it to chance. Do something with your money. Take control of it. Take control of your life, and therefore have control of your own freedom and your own destiny, and have that time with your family. Be the envy of the neighbors on your block. Be the people that your kids can look up to and say, man, like my mom or my dad, they were smart with money. Like they were the rich dad in the story of Rich Dad Poor Dad. They weren't the poor parents. They were the rich parents. They're doing it right. You can take control of your own destiny. The choice is yours. Guys, make a wonderful and prosperous week. We'll see you later.